Hey, good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of protecting your clients' portfolios and profiting in a market correction. Presenting today is Mark Chaikin, founder and CEO of Chaikin Analytics. Now, as a reminder, you are welcome to submit your questions using the Zoom Q&A window. This webinar is being recorded, and a copy will be sent to everyone who has registered. Today's presentation is expected to last about 1 hour, with Mark Chaikin providing a special offer at the end. So now to get us started, here's Mark Chaikin.
Thank you, Joe, and welcome everybody. We have an awful lot of valuable material to cover today, and as Joe said, if you can just give us those extra 5 or 10 minutes in case we run a bit over, we've got a special offer at the end. Obviously, we're talking about something that is very, very relevant in the current market environment, which is the potential for a market correction or even a bear market. My experience speaks to having lived through a lot of that. It's almost like living through a hurricane. Sadly, we hope it passes by continental United States, already wreaking havoc. I've been on Wall Street for over 50 years. I've lived through 10 bear markets. I know how painful it is and what kind of hand-holding you have to do with your clients. And we're going to show you some of the tools that I've used as a financial advisor, as an institutional analyst, as someone who's talked to people, written a market letter for over 40 years, a weekly market letter, to get people through bear markets and profit from them. For 45 years, I've been using technical analysis, but always in conjunction with fundamentals. So really what we're going to be talking about today is how Chaikin Analytics synthesizes the fundamentals in a very clear, concise, powerful, and predictive multi-factor model called the Chaikin Power Gauge Rating. And because I've been mentored by some of the smartest and most successful institutional investors, some of whom were colleagues and some of whom were clients, what I learned from them is reflected in the Chaikin Power Gauge Rating. It's the culmination of my life's work. Imagine if you could bottle up everything that you've learned if you've been in the business for 10, 20, or 30 years and pass it on to your son if he's taking over the business, or to a colleague. This is what I've done with the Chaikin Power Gauge Rating. Now, in the next 45 minutes, perhaps an hour, you're going to learn how to protect and profit in a correction. You're going to zero in on finding bearish stocks using the Chaikin Power Gauge Rating and relative strength, how a stock's doing to the market. We're going to show you a special pattern using Chaikin Money Flow to predict future price movement. Chaikin Money Flow, as many of you know, has been in the public domain for over 35 years. It's on every major terminal like Bloomberg and Reuters. It's also on all the online brokerage platforms, so your clients are looking at this. I'm going to show you how to spot signs of an impending correction or a bear market, how to identify weak sectors and industry groups, and most important, how to play good defense, because part of the way that you protect and profit in a bear market is by avoiding the landmines that can destroy portfolios, whether you're allocating client assets to individual stocks, building portfolios from the bottom up, or whether you're using exchange traded funds or mutual funds. It's very important to know some of the warning signs. And finally, we're going to show you how to take advantage of corrections by finding the right stocks to buy on weakness. Now, I'd like to start out by asking you a question. Are you thinking about a bear market? And Joe Bacella is going to put up a poll here. Very simple. Are you thinking about a bear market? Yes, I'm uncertain, or no. Please check one box so we get a feeling for what the tenor of the room is, the people on the webinar today.
All right, we've got about half the audience responded. Give it about 5 more seconds. Almost everybody in. And let's take a look at the results here. A lot of participation. Thanks, guys. It looks like mostly yes. 64% say yes. About 18% say uncertain. The remaining 18% saying no.
Well, this is about as bearish a crowd as we've had on these webinars. And I think we're going to put some of your fears to rest. At least I hope we will. So bear markets don't come from political events. So if you're worried about the potential for an impeachment proceeding against President Trump or continued gridlock in Washington, the history over the last 50 years is that unsettling political events did not cause bear markets. I'll just read a couple of them. Assassination of President John F. Kennedy. I was in my junior year in college in 1963. The bull market resumed within 2 days. Sad but true that Wall Street is not sentimental. Kent State shootings looked like we were going to have civil war in America over the Vietnam War. We were in a bear market that ended 1 month later, and so forth and so on, including the impeachment proceedings against President William Clinton in December of 1998. The bull market, as we all know, the internet bubble continued for another 2 years. So if you're leaning toward the bearish side because of what's going on in Washington, it doesn't work that way. In fact, it often creates buying opportunities. Now, what does predict a bear market are a set of reliable economic indicators that have always turned down before every recession going back to 1960. There are 3 of them that I key in on, and 2 of them are on the screen. One of them is the 12-month moving average of housing starts. You can see from the gray shaded period that the 12-month moving average of housing starts has always peaked well ahead of every prior recession, and bear markets key off recessions. The only bear market in my lifetime that didn't key off a recession was the crash of 1987, which was triggered by portfolio insurance. It was painful. There was a 25% decline in less than a week, but the markets came roaring back. The second economic indicator that's always turned down ahead of a recession is the ratio of leading to coincident indicators from the conference board. Now, ironically, one of the leading indicators is the stock market. So if the stock market hasn't turned down, the likelihood of a recession is pretty small. The third one that I use is the inverted yield curve. I'm sure you're all familiar with that. The yield curve can flatten, but unless it inverts, a flat yield curve is actually bullish. So if we're not going to get a bear market, or at least there's no signs of a bear market, we may get a pullback. And in fact, in our weekly market letter, Chaikin Market Insights, I've been looking for a pullback. Why? Because of some internal deterioration that we're going to look at in a minute in some of the technical indicators and the breadth indicators. So what are breadth indicators? They're the number of stocks that are advancing versus declining, the number of stocks making new 52-week highs and lows. And we're going to show you 2 proprietary Chaikin technical indicators that have been very effective at identifying potential corrections. But the main reason we've been cautious, in addition to the market's inability to get through 2,500 on the S&P, is that the September-October time framework is the worst time for stocks. Almost every crash in my lifetime and back to 1929 has happened in October, and September is the 1 month of the year that's on average down over the last 20 and 50 years. So what is a pullback? Well, a decline of 5 to 10% in the S&P 500 is considered a pullback, and since 1945, that's 72 years, there have been 75 of them. They come roughly once a year. Now, we haven't had one since Brexit in June of 2016. We came very close before the presidential election when we had 9 straight down days. The average decline in a correction is 6%. It typically lasts 1 month, but what's most important is that within a month you recover all of that decline and move on to new highs. So corrections are your friend. Pullbacks are your friend. Now, how many bear markets have we had? Well, a bear market is defined as 20% decline in the S&P 500, or one of the popular averages, and there have been 11 of them only since 1945. That means approximately once every 6.5 years. So if you're always looking for a bear market around the next corner, you're missing out on a lot of opportunities. If you're parking your clients' assets in defensive stocks or putting them into cash or bonds here, which are very vulnerable in my view, you're missing opportunity. And don't be misled by the talking heads on CNBC telling you that this bull market is long in the tooth. Yes, at 8.5 years, it's the longest bull market that I've ever experienced. But look what it came out of. It came out of the ashes of the financial collapse of 2008. And by the way, that was the impetus for me to create the Chaikin Power Gauge rating. So there was a bear market that almost undid the global financial system. And thanks to quantitative easing and slow growth here in the US, we've been in an 8.5 year bull market. But duration And even valuation does not predict the onset of a bear market. The only thing that I know that does it predictably are those three economic indicators that we just keyed in on. Now, periodically, you're going to find someone on CNBC talking about some new indicator they've just come up with, which has predicted recessions. The three that I talked about are the only ones that have predicted every recession since 1960, and they're not hard to follow. So what kind of market is this? Well, I call it a Yogi Berra market. It ain't over till it's over. So what's important for you as advisors in building your practice, in interacting with your clients and managing your clients' portfolios is to have a sense of the market direction, to have a good handle on the trend of corporate earnings, to know where interest rates are headed, and most importantly, to have a sense of where institutional money is flowing, which sectors and industry groups are strong, and which sectors and industry groups are weak. And most people look at price momentum. I know many of you use Dorsey Wright, follow Standard & Poor's, William O'Neill. We have a very different take on it. We like price momentum and relative strength, but we look at our power gauge rating, the fundamental potential for the stocks within a sector or an industry ETF, and we're going to show you how we do that. Now, the one wild card in this listing is interest rates. It was widely anticipated that with the Trump victory, we'd get infrastructure spending, we'd get interest rates going up because of tax stimulation and so forth. That's why the financials jumped after the presidential election. Large cap financial stocks were up 20% between November and February when interest rates peaked. Small cap financials were up 40%. Reality is interest rates have flopped back down. That's a big surprise to me because I expected we'd see a 3% 10-year treasury by year end, currently at 214. It's a big important fact because financial stocks have been underperforming, and with the hurricane or the dual hurricanes that are hitting the insurance stocks have taken it on the chin, maybe a great buying opportunity in insurance stocks as soon as the dust settles and we see what the damage is from Hurricane Irma. So let's take a look at the market. And when I look at the market, I like to look at the SPDR, the Select SPDR Sector ETF, which represents the S&P 500 large cap index. The reason I like to look at it is that it is the most actively traded instrument in the US markets. And institutional investors use this to get equity exposure quickly. So Chaikin money flow, which is our go-to supply demand indicator that tells you what institutions are doing, instead of you having to guess at it, fluctuates between red and green around a zero line. It looks back over 21 days. And it's done a great job in this bull market that began at the presidential election and even going back to February of 16. We're up over 25% since then, at showing you that institutions have been buying the dips. They've been buying the rallies. They just want to be long equities. But there are two chinks in the armor here. First of all, as the market rallied up off this double bottom, and by the way, that double bottom came on extremely heavy volume. This is one of the real precepts of technical analysis that I've embraced for the last 45 years. High volume declines are almost never the end of a decline, particularly when you've got a W-shaped bottom. So both legs of this recent decline, which by the way was barely 3%, came on extremely heavy volume. And so the rally was suspect from my point of view, and the fact that the market has now gotten overbought on a short-term basis and Chaikin money flow has stayed negative, it's red not green, tells me that smart money is taking some money off the table on this rally. The second thing that I'm cautious about is what we call our power bar. For every index, ETF, industry group, or list, client list, or list that you create in our system, we look at the number of stocks with bullish potential versus bearish potential. That's what the power gauge does. So there are only 76 stocks in the S&P 500, with the S&P as of right now within 1.3% of its all-time high with bullish ratings and 119 with bearish ratings. That's an internal divergence that tells me this rally is unlikely to have legs to catch hold even though they're now talking about a compromise in Washington. So how do I put this whole picture together? Well, I expect the market to be higher by year end, probably in the 2,500, 2,550 area. I'm cautious about the market because of negative seasonality in September and October. And I'm looking at our internal technical indicators as well as a drop in the number of stocks making new 52-week highs and lows. So I'm going to give you a little bit of bearishness here, but I'm not looking for a bear market. I'm thinking correction. So how do you protect a client portfolio if we have a September-October correction? It's very simple. One of the most liquid options is the select spider sector option. And in this case, the high probability way using options play, which we've licensed and bundled into Chaikin Analytics, is to do what's known as a vertical put spread. You buy a put spread that's slightly in the money. In this case, the October 247 put that expires on October 20th, so it gives you 6 weeks of protection. And against that, you sell the October 236 put. What you've basically done is reduce the cost of the put from $384 to $248. Options play rates it green with a check mark, high probability, and look at the profit potential, 350% as a speculative trade if the S&P drops 3.5% between now and October 20th. It also means that for $250, you can protect $25,000 worth of a client portfolio against a 4% drop in the market. So if you've got a client with $250,000 in the market, you buy 10 of these spreads, it costs you $2,500, and that client can sleep at night if all we're going to see is a correction back down to $2,360, $2,400. So really simple. It's a speculative trade, but it's also a way to put on some portfolio protection that's relatively inexpensive. Now, as we poll clients on webinars like this, and as our customer success team talks to our institutional clients, what we've learned is that information overload is everybody's biggest problem. There's too much information. If your goal is to build your practice, you've got to have time to prospect and you've got to have time to talk to your important clients. But there's just too much information. So what Chaikin Analytics does through the Chaikin Power Gauge rating is cut through the clutter. Even if you're allocating client assets to ETFs and mutual funds, you've got a lot of clients who have another account somewhere where they're buying and selling individual stocks. With the Chaikin Power Gauge rating, we look at multiple factors, 20 factors, as you'll see in a few minutes, on 5,000 US equities. So we cut through the clutter by enabling anybody who uses Chaikin Analytics, and hopefully you will see the light and become a subscriber at the end of the webinar. That's the only pitch I'm going to give you till the end. Enables you to be conversant, to be intelligent, to have an informed opinion based on independent third-party research that's been validated, as we'll see in a minute, on any one of 5,000 US equities. If you're building portfolios from the ground up, and we know that 50% of advisors still do that, in spite of what you read in the paper, this is invaluable, and it is the centerpiece of Chaikin Analytics for both iPad and desktop. It's our solution to information overload. Now, we've gotten a lot of validation. Why is this important? Because there are a lot of tools out there that claim to do this or claim to do that. But we have some very important hedge funds like Paulson Hedge Fund, Soros, Fidelity Investments uses the product. John Malden of Malden Economics, who is highly regarded and followed with his 2 free newsletters in the advisor community, has become a big proponent, as you'll see at the end of the webinar. And we've been favorably reviewed in Barron's and Forbes. And just 3 months ago in May, we won the Benziga FinTech Award for Best Ideas Platform, beating out 19 other contestants, people who were picked to enter that category. So lots of validation in the media. And because the Chaikin Power Gauge rating is fabulous at identifying stocks and has been for over 6 years that are vulnerable, it takes the sting out of corrections. It enables you to zero in on vulnerable stocks using a combination of fundamentals and technicals folded into a multi-factor quantitative model that's been blessed by Nasdaq, by New York Life Insurance Index IQ subsidiary, by First Trust Portfolios, And then we give you some buy and sell signals for better exits and entries. Now, at Chaikin, we teach a disciplined methodology for bottom-up stock picking. It starts with the power gauge rating at the top of the pyramid and sector and industry group strength. And again, we measure it using the Chaikin power gauge for the constituents and relative price performance. So it's a combination of fundamentals and technicals. At the bottom of the pyramid, Chaikin money flow and relative strength. If you want to follow technicals, you don't have to be a rocket scientist and spend a lot of time on it. Very simple. In fact, we have one advisor at Morgan Stanley who said, Chaikin gave me back my weekend because she used to do fundamental and technical research to supplant Morgan Stanley's research on the weekends. She now has time for her children. In the middle, buy and sell signals to help with timing. Now, before we teach you about the Chaikin power gauge rating, why it's so powerful and what it's comprised of, I'd like to show you some examples to whet your appetite. We have a pattern called classic Chaikin bulls. The power gauge rating is bullish, which means fundamentals are positively aligned for that stock. Stock is outperforming the market, and Chaikin money flow is strong, indicating that institutions are accumulating the stock. And for the last 12 months, Applied Materials, AMAT, a semiconductor equipment manufacturer, has been leading the tech sector higher. How do we know that? Because on the bottom of this one-year chart is the Chaikin power gauge displayed as a ribbon that fluctuates from green to yellow to red. Now, it's never been bearish for the last 15 months, but it has turned neutral here. But look what happened along the way. Going all the way back to September of 2016, AMAT was trading at 28. It peaked at about 48. And it was outperforming the market the whole way up. And you can see the institutional accumulation. Now, two other important pieces of information on this chart. We color code the earnings to let you know whether a stock has, or a company rather, has beat Wall Street estimates, matched them, or disappointed. And you'll see when we show you the factors in the power gauge, and I explain why that factor is in the 20-factor model, how important and why. And then we also show you our buy and sell signals. So we have something called an oversold buy signal. It's a great way to enter a new position, to add to an existing position, to give you some confidence that you can take advantage of a correction or a decline instead of worrying about it. Now, at the right-hand side of the chart, we see that AMAT is rolling over. The tech sector is still strong. We'll see Lam Research, which has gone almost step by step with AMAT, is still making new highs. So people often say, well, how do you know when to sell? Well, here's a perfect example of how to know when to sell. Let's say you bought the stock on any of these buy signals between 28 and 32, or even up here at 38. AMAT is now trading at 44, 45. It's overbought. Money flow is red, not green, and the stock had resistance at our trend line, and it didn't make a new high as it did on the previous two moves. So we're going to take this out of our portfolio. We're going to stop using it as our poster child, although I like the ability to give you a sell example right up front. But here's a classic Chaikin bull in action. Now, a classic Chaikin bear is turning this on its head 180 degrees. Power gauge rating is bearish, meaning that the fundamentals are negative for that stock. Could be overvaluation, could be analysts reducing their estimates. Power gauge rating is bearish. It's underperforming the market. There's nothing worse than owning a stock with bearish fundamentals that's making new 52-week lows, with Chaikin money flow red, not green, telling you that the institutions are selling whenever they can. And here's our poster child, and it has been for over a year, Under Armour. Now, I know many of you had clients that were interested in Under Armour. A lot of brokerage firms and hedge funds were big proponents of the stock when it was trading in the 40s. But the power gauge rating turned bearish at about 42 in roughly July of 2016. And look at what the institutions were doing. Based on what I've told you about Chaikin money flow, do you think the institutions were buying or selling the stock back in the fall and winter of 2017? If you think they were buying, type a big B in the question box. And if you think they were selling, type a big S. And Joe, tell me what kind of response we're getting, please.
Yeah, let's take a look here. Just going to give it a few moments. And I see some S's trickling in.
Well, the reason the S's have it in this case is because Chaikin money flow was built to be visual. If the institutions are selling consistently, Chaikin money flow is going to be red. It's not going to go above the zero line, even on rallies, which is this special pattern we're going to teach you. But everything is lining up negative for Under Armour. It still is. So the Chaikin Power Gauge rating could have encouraged you to get this out of client portfolios. If you trade options, perfect put candidate. But it also does something that's even more important. It discourages bottom fishing. I've said on CNBC and I've said on these webinars that bottom fishing is the most expensive sport in America. You're basically playing God, telling the market that you know more than the big institutions, than the hedge funds that are in the marketplace. And it would have been very tempting to buy Under Armour here in this 16, 18 area. But the bottom line is, unless you've got the patience of Job or you're Warren Buffett and you really know the fundamentals and know that Nike is not going to become a viable company again, or that Adidas is going to come out and out of nowhere blindside both Under Armour and Nike, bottom fishing just doesn't work. And so that's why we call this a classic Chaikin bear. Prior to the Under Armour, we were looking at Chipotle. Before that, it was Kinder Morgan. Before that, it was Wynn Resorts. All these stocks dropped 80%. And you can avoid that kind of devastation by having a disciplined approach that looks at the fundamentals objectively. Now, we also have a way to screen for classic bears because it's important to know which stocks your clients hold or which stocks you might be thinking of buying that have bearish ratings. So I started with the Russell 3000, required that the power gauge be bearish, looked at those two technicals, money flow and relative strength, just interested in mid and large cap stocks. And I added just one other factor to filter the list down. I want a company in this list that has a history of negative earnings surprises. And we narrowed the Russell 3000 down to 28 names. And these are the stocks that have been under pressure, that are likely to continue to be under pressure, like Chipotle and Kinder Morgan. Now, will a stock on this list rally eventually? Of course it will. But the point is, you don't have to worry about that because there are so many stocks with bullish ratings, classic bulls that you can buy. You sleep better at night. You have fewer client phone calls that are disappointing and require time and hand-holding. So just being able to screen for them is extremely important. Now, all of this at its core is based on the Chaikin Power Gauge rating, a very simple display that goes from very bearish to very bullish, but there's a lot going on under the surface. And I've said many times on these webinars that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. And as you'll see, it can be your GPS during earnings season. Earnings season is very troublesome for clients and for advisors because there's so much volatility when companies either disappoint or report better than expected earnings. And the Chaikin Power Gauge rating puts the odds on your side because a bullish rated stock is twice as likely to report a positive earnings surprise, whereas a bearish rated stock is twice as likely to report a negative earnings surprise. Doesn't work all the time, but it works often enough, as you'll see, that this becomes a go-to indicator for a lot of advisors. Now, one of our partners is John Carter, probably the best pure trader I've ever met. He's got a trading room called Simpler Trading. And John got introduced to the Chaikin Power Gauge rating by one of his subscribers in the trading room. And there are a lot of smart, moneyed people in that trading room. And he got excited and called the Chaikin Power Gauge rating an awesome objective meter for stocks because it looks at 20 technical and fundamental factors to anticipate a stock's profit potential. And he's seen everything. He said there's a lot of hyped up tools out there, but when I find something interesting, I'll let you know about it. So let's look at those 20 factors that got John Carter so excited. They cover value, growth, technicals, and sentiment. These are the same factors that the strategists at Merrill Lynch or Morgan Stanley or UBS look at when they're evaluating the market. Now, within each of those four primary factors, we've got 5 sub-factors. And the reason the power gauges work, since it was introduced in January of 2011 in the form of research reports on 5,000 US equities updated nightly, is because these factors are what Wall Street professionals who've been successful look at every day before they make investment decisions. Now, 85% of the model is fundamental, only 15% is technical. And in the fundamental factors, the value factors are 35% of the model. And the two most important factors are price to sales ratio and free cash flow. So we're incorporating what Warren Buffett and Seth Klarman look at and Graham and Dodd advocated over 80 years ago. And we're looking at price to sales, which Bob Arnott at Rafi, many of you buy Rafi products through Schwab, mutual funds or ETFs, has said that his secret sauce of the four factors he uses to weight indices has been price to sales. If you pay too much for $1 of revenue, you're skewing the odds against profitability of that position. Now, we have shorter term factors in the model, but they also persist over time. One of them is earnings surprise. So when I was at Drexel Burnham in the mid-80s, George Douglas, who created Drexel's quantitative database, DAIS, who's still managing quant money today, gave me access to the database and shared the research that he did on earnings surprise and earnings estimate revision. I learned two things from George. One was that earnings surprises come in bunches. There's never just one of them. And that earnings surprises lead Wall Street analysts to raise or lower their estimates. And then further research has shown that analyst estimate revisions are the single biggest short-term driver of stock price movements. So in the power gauge with 20 factors, we've got longer-term value metrics that don't change very often. Then we've got some shorter-term factors that introduce the element of sensitivity into the model, and they tend to persist. So it's not just a one-off, one-time event. And then finally, very important to look at industry group relative strength, because as we'll see, industry group and sector trends are based on macro factors and they persist over time. And that's another way that you can protect client assets in bear markets or in corrections, by knowing which industry groups are out of favor and attracting selling. Then finally, we look at insider buying, because it's a great way, particularly in small caps, to get an edge. If you follow the insiders, you're putting the odds in your favor. Now, James O'Shaughnessy, who is a successful investor and has written 2 books on quantitative investing, says models beat humans. Models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. I couldn't agree more. I'm sure all of you are familiar with the studies that show that the average mutual fund was up 9%, 9.4% over the last 30 years, and the average investor in mutual funds is up only 3.4%. And the reason is they buy high and they sell low, doing the exact opposite of what a model is likely to do. So let's look at the performance of the power gauge. 2016. We use the Russell 3000 as our universe. Each of these silos is equally populated, so we're not playing games at the tails. And the average very bullish stock was up 32% in 2016, using what's called a 1-month rebalance, which is how all models are measured. The average very bearish stock up only 9.5%. So ask yourself this: if you're building a client portfolio, or if you're buying an ETF, would you rather be in a stock or an ETF that's populated primarily with very bearish rated stocks in a proven objective quantitative model, or in the very bullish stocks? Well, it should be obvious, but just to make the point even more clear, in 2015, we had a bear market in energy stocks and small caps. So the very bearish stocks in the Chaikin Power Gauge rating were down 17% in 2015. These were the Kinder Morgans, the Range Resources, the Pioneer Energies of the world, the rails that moved all this stuff around, the steel stocks and so forth. The average very bullish stock did what the market did, roughly down 1%. So if you can avoid those very bearish stocks in client portfolios, you're a hero. Eliminate 1 or 2 stocks. Imagine what that does to the performance of a client portfolio. If you can eliminate a Kinder Morgan or an Under Armour or a Chipotle early enough so it makes a big difference. Now, we've got two other validations for the Chaikin Power Gauge. We entered into a partnership with Nasdaq. In April of 2014, we created 3 Nasdaq Chaikin indices: large cap, small cap, and dividend achiever. The goal was to develop a live track record for these indices that are rebalanced once a year. So at this point in the webinar, a lot of advisors are thinking, well, this isn't for me, this is short-term trading stuff. Well, it is not short-term trading. We built 3 portfolios that are rebalanced annually, 3 indices. They've gone through 3 reconstitutions, and they've established a fabulous track record, as you'll see on the next slide. And because of that, New York Life Insurance's Index IQ subsidiary licensed all 3 of them, registered them with the SEC in February as the basis for exchange-traded funds. One of them has been live since May, and it's a small cap fund, the CSML. This is not meant to be a recommendation to buy it, but it's garnered 170 million in assets in just 3 months. It's the 3rd most successful ETF launch of 2017 out of 98 new ETFs. It's the most successful multi-factor ETF. So if you've been reading about passive versus active, multi-factor versus single factor, this is a multi-factor approach to stock selection and portfolio construction. And here's the proof. Just looking at the small cap index for the 3 years that ended March 31st. Remember, these are portfolios that are rebalanced only once a year, so they're buy and hold portfolios. The Russell 2000, which roughly equates to the Nasdaq 1500, was up 22% in that 3-year period. The Nasdaq Chaikin Small Cap Index up almost 44%, virtually double the benchmark. That's alpha, and it comes from the multi-factor model being the final step in the selection process for a stock to be in the indices. Now, let's get to some really specific and valuable examples that you can use every day. In my view, the key to protecting client portfolios and actually making profits in corrections or bear markets is something I call spotting personality changes. We define a personality change as a stock that goes from outperforming the market, so our relative strength indicator is green, to underperforming. And it's absolutely critical that you be able to identify those stocks, because very often on Wall Street, we put our feet in cement. We form an opinion about a stock and we never give it up. So there are people who ride stocks like Under Armour all the way down, or Kinder Morgan, or they get greedy and fail to see that a stock that they like has started to underperform the market. We'll start out with a bullish case, because we are going to show you some ways to find bullish stocks in a correction. And here we're looking at a 1-year chart of Anthem Health, one of the biggest Medicare and Blue Cross Blue Shield providers in America. And beginning right after the presidential election with the power gauge bullish, notice the green ribbon at the bottom of the chart, Anthem Health broke out of a long base at about 130 and started outperforming the market. We call that a bullish personality change. And look what the institutions were doing. They jumped on the bandwagon, buying the stock whenever they could, buying it on dips, buying it on sideways movements, buying it when it got oversold. So if you're building stock portfolios, your job is to wait for a buy signal, what I call a low risk entry point, and then just ride the stock as long as the indicators stay bullish. And notice that Anthem Health made a new all-time high as recently as yesterday, in a very bad day for the stock market. Now, money flow is deteriorating a bit, but it's still bullish and outperforming the market. Now, here's a bearish personality change. And this is what you really have to indelibly imprint on your mind to cope with bear markets and to profit and sidestep problems in a correction. When a stock that's been outperforming the market, particularly when the power gauge rating is neutral, meaning that the fundamentals were not supporting that high momentum advance, and that's the case with this drug stock, Tesaro, starts underperforming, we call that a bearish personality change. That's a big red flag telling you to evaluate your fundamental view on the stock. And when the power gauge rating is bearish, I don't even think twice. I want that stock out of my portfolio. Someone once called the power gauge rating Visine for your portfolio. It gets the red out. And look what's happened to Tesoro since the bearish personality change. It's gone nowhere. Every time it rallies, it runs into institutional selling. It's got a history of negative earnings surprises. And these sell signals give you a wonderful opportunity to get out of the stock if it's still in your client portfolios. And sometimes it's absolutely critical that you get out of a stock that's had a bearish personality change. Here's a chart of SunEdison that ends in April of 2016. Why did it end in April 2016? Because the company filed for bankruptcy. Now, this was a darling of the hedge funds. Sadly, Merrill Lynch was recommending it up in the 28-30 area. Not to slam Merrill Lynch, a lot of brokerage firms like this stock. But there was phony accounting going on. It looked a little bit like Enron, and the power gauge picked up on that because the power gauge rating was bearish. And the institutions were selling even before the bearish personality change. They knew something. Negative earnings surprises all the way down. Rallies that didn't attract buyers. So I have a philosophy that it's never too late to sell a stock if everything's lined up against it. And you certainly don't want to bottom fish in a stock like this. Now, when did Merrill Lynch finally throw in the towel? Back here in February with the stock at $3 on the way down from 31. And we were in an options industry council show in May of 16, and I was demoing our system, and I used SunEdison as an example. It had just filed for bankruptcy, and I kept that chart. And an advisor walked over to me, and he said, well, could you go back to that, please? And he gave us this testimonial. If I had Chaikin, he said to me, I bought SunEdison at 15 on the way down because Merrill Lynch was still recommending the stock. I bought it for my own account and for my clients' accounts. If I'd been using Chaikin, I would have saved a lot of money in pain. Ironically, we're in Philadelphia. Edward M. is right outside of Philadelphia. We had to travel 300 miles for him to see the value of the Chaikin power gauge rating, and he almost immediately became a subscriber. One more pattern, and then we're going to show you some top-down ETF sector and industry group analysis. There's a pattern that we've been teaching to institutional investors for over 30 years. We call it the secret sell signal that 95% of investors never see. It's a Chaikin bearish money flow sell alert. And the classic example of it is Advanced Auto Parts back here in January of 2017. The stock had made a peak up here above 170, and Chaikin money flow did what it was supposed to do. It turned green. But the fundamentals didn't support the move. The stock then pulled back. Institutions started selling it, and when it rallied up and equaled that previous peak, was Chaikin money flow green? No, it was red, because the institutions were selling into strengths. We call that a money flow sell alert. It's the only technical indicator I know that can actually help you get out of a stock at its all-time high with a high degree of confidence that you're not leaving anything on the table. Now, along the way, the power gauge turned bearish again. The stock had a bearish personality change, negative earnings surprises, institutions selling, and then right after we put out a sell signal, as you'll see, saying sell the auto parts stocks on strength in April, we got an overbought sell signal, and then a bearish earnings surprise ensued, and the stock dropped from 148 all the way down to 100. This chart is not up to date. We're going to see the up-to-date chart in a moment. So that's your bearish money flow sell alert. These patterns recur over and over and over again. Now, how can you use sectors and ETFs to allocate client assets? Well, we have the special power bar ranking that looks at the 10 select spider sector ETFs and ranks them by the number of stocks in each of those ETFs with bullish versus bearish ratings. We also do that for industry groups, for individual ETFs. You can then drill down on strong and weak sectors based on the power bar and price momentum to find the best and worst stocks in those sectors. You want to focus on the best and avoid the worst. And then you find those stocks and you adapt and adjust your portfolio, and you talk much more intelligently to your clients. So I've always said that industry group sector strength gives you a tailwind. And it's been validated by research that William O'Neill has done at Investors Business Daily, Sam Stovall at Standard & Poor's, now he's joined IFSA, and Zacks Research. Someone once said, and I think it was William O'Neill, I'd rather own the weakest stock in a strong industry group than the strongest stock in a weak industry group, because weak sectors and industry groups give you headwinds. You're swimming against the tide, crossing the wrong way on a one-way street. Much harder to make profits on the long side in a weak sector or industry group. So this is what our sector power bars look like. These are the 10 select spider sector ETFs. Right now, there are only 3, utilities, healthcare, and technology, with more bullish than bearish stocks. This number has varied between 3 and 5 for the last 3 months, which is why we've been cautious on the market. And then right at the bottom, energy, with no bullish stocks in the S&P 500 based on the Chaikin power gauge rating. So if you're bottom fishing in energy, you're going against the tide. Same is true with consumer staples, only 2 bullish. Real estate, defensive stocks are weak right now in addition to energy. Now, here's an example of a strong sector. This is the XLK, the Select Spider Sector Technology ETF. 2 things to see on this. We are going to have power gauge ratings on ETFs within the next 3 months. We've been saying that for quite a while. It turns out that building a power gauge rating that combines fundamentals and technicals for ETFs is a little bit like healthcare. When President Trump said, who knew it would be this difficult to pass a healthcare bill? Well, who knew it would be this difficult to get a power gauge rating for ETFs, but we're almost there. But even before then, you have 2 key Chaikin technical indicators, relative strength and money flow. And you can see that the institutions were buying the XLK and it was outperforming the S&P 500 all through 2017. And you had 2 wonderful opportunities here on this W-shaped bottom to get into tech stocks, buying stocks like AMAT, or as we'll see on the next slide, Lam Research. Now, what's the difference between Lam Research and AMAT? They're in a very similar space, semiconductor equipment manufacturers. The big difference is that Lam Research has recently made a new high, as recently as a couple of days ago, and AMAT, as we saw, has failed. So if I own both those stocks, as some of our client portfolios did, I'm going to be selling AMAT and staying with Lam Research. But these signals, knowing that the sector was strong, are wonderful entry points. It gives you the courage to pull the trigger and buy the stock on dips. This is what Wall Street pros on the floor of the stock exchange have done for years. And you can do it too. Now, they don't all work out right away. About 2 out of 3 are very precise. Sometimes you have to live through a little bit of a correction, but if you're solid on the fundamentals and the power gauge rating tells you that, then you're more confident about staying with that position. Now, there are weak stocks in strong industry groups. So I'm not sure I agree with William O'Neill or Zacks. It was one or the other who said, I'd rather own the weakest stock in a strong industry group. Because here's an example of a weak stock in the technology sector. Seagate makes hard disk drives, power gauge, and relative strength both turned bearish. There's your bearish personality change after an earnings report that Wall Street didn't like. And then right ahead of the next earnings report, Seagate had been rallying. It rallied up to about 39. We got a sell signal right before the earnings report. The stock disappointed and dropped from 39 all the way down to 30. So a drop of over 25%. You can avoid those drops. You can avoid that whole pain and suffering and sleepless nights about not knowing what to do and taking those calls from clients by following a disciplined methodology. Now, healthcare was the other sector that's been very strong in making new highs, and the strongest group within healthcare are biotech stocks. Now, this slide shows you biotechs making new highs, but back here in June, we used this slide in a webinar to show you that biotechs were breaking out to new highs, June, July, right in here at 75. That sector is up 15% since then. It's been outperforming the market. And here's an example of a biotech stock. We highlighted it in our weekly market insights by running a screen for strong biotech stocks. Power gauge ratings bullish. Stock was in a very steep downtrend. Notice why relative strength is so important. When the market agrees with the model, Wall Street is confirming what the fundamental factors are saying. And then you got a positive earnings surprise. The stock spiked up, profit taking, because as we know, biotechs are very volatile. You got an oversold buy signal here at 72, and the stock spiked up to 82 on some favorable news about one of their new drugs. It doesn't have to be more complicated than that. Follow the signals, follow the discipline, but notice what happens when you have the bullish personality change. That's when you get price acceleration. So if you're patient and wait for everything to line up, Warren Buffett calls it the ideal setup or the fat pitch, good things happen to you. Now, I also said industry groups are important because within each sector, there's a lot of different cross currents. So again, for a webinar I did in July, I looked at industry groups. These were the strongest rated based on the power gauge, zeroed in on apparel for a reason I'm going to show you in a moment. And right at the bottom, as you would expect, were the energy stocks. Now, these are not just large cap. These are small and mid and large. These are the S&P sub-industry groups. But if you can separate out the strong from the weak, do a top-down analysis, orient your portfolios, your ETFs or your individual stocks to be long the strong and short the weak, or out of the weak, you're putting the odds in your favor. So in my weekly market letter on Sunday, July 9th, I had just finished reading Barron's, which pointed out that the apparel group had turned bullish. Well, I'm not going to believe Barron's. So I went into Chaikin, I looked at the industry group power bars, there was apparel, and then I looked at the individual charts by screening for bullish power gauge rated stocks in the apparel group. And I had a list of 4 apparel stocks with bullish power gauge ratings to buy on pullbacks of 1.5 to 3 days. Because I knew based on the Barron's article, they would be up the next day. So Michael Kors, 36, positive earnings surprise, 3 weeks later, spiked up 10 points to 46. PVH, a stock that was plagued by the potential for a border tax on imports. The yellow arrow is where we recommended it, and the stock has just kept going. It went from 112 all the way to 127. Bullish personality change preceding that recommendation, power gauge bullish, money flow coming into the stock finally. Once the news of no border tax surfaced, the stock just kept going. Now, my bullish stock of the week this past Sunday was Kohl's. 1 stock, not 4. And the reason was Amazon's not going to take over the world. They're not going to be successful at everything they do. And I was looking for bullish retail stocks. It goes a little bit in the face of don't tread on weak industry groups, but the consumer discretionary sector is actually not bad. And of the stocks with bullish ratings, Kohl's had just turned bullish. And I thought, well, this is interesting. Money is coming into it. The power gauge has just turned bullish. This was as of the previous Thursday. And so I recommended the stock. And today they announced a deal with Amazon. This stock's up 7% in the last 2 days in a market that's gone nowhere. So if you follow the discipline, sometimes you get lucky. Better to be lucky than smart, I've been told. And here's an example of that. Now, finally, let's look at how you play good defense, because good defense leads to good offense and improves portfolio returns. So we often hear, well, Chaikin has helped me in a bull market. Well, you could throw darts and make money in a bull market. And my response has always been, well, that's true unless your dart happened to land on an energy stock. This is what a bear market looks like. Richard Wyckoff, who was the premier market strategist of his day, this goes back 90 years, idealized up and down moves. And this is how he defined a bear market. Distribution, breakdown, does that look like Under Armour to you? In a minute, we're going to see Kinder Morgan, same thing. This is what a bear market looks like. And this is a 5-year chart of the XLE, the Select Spider Sector Energy ETF. It peaked in July of 2014 with the bull market roaring, and it dropped from 100 all the way down to 50. These are the large cap energy stocks in the S&P 500, all of them. 50% drop over about 18 months. That's a bear market, and the relative strength picked that up. Now, while the XLE was dropping 50%, Kinder Morgan was doing a levitation act. The company was rolling up its MLPs, 20% dividend. Even some of the smartest investors I know wouldn't give up on Kinder Morgan. But when Kinder Morgan finally gave up the ghost, as we'll see on the next chart, it didn't drop 50%, it dropped 80%. It went from $42 to $10. That's painful. And you don't want to take those client calls. Now, here's what Kinder Morgan looked like along the way. This chart goes from February of 15 through February of 16. It shows you where the power gauge and the whole Chaikin discipline turned negative on Kinder Morgan. The stock was $40 on its way to 10. Bearish personality change, power gauge goes negative, institution selling. Anytime you get a rally, you got an opportunity to get out of the stock, whether it's at 35, 30, 25, or even 15 on the way to 10. It's better than writing it out, not knowing if the company's going to file for bankruptcy or not. Now let's look at what's happening in energy in 2017. Here's the XLE. It's a one-year chart now. Notice that we had a bearish personality change in January of this year. And since that bearish personality change with the stock at 73, it's bottomed out below 62, more than a 15% decline in energy, almost a bear market. So as advisors, your mission is to find stocks in the energy complex with bearish power gauge ratings, like Schlumberger or Helmerich & Payne or Kinder Morgan or Halliburton, and make sure that they're not in your client portfolios. Or if they are, be prepared for a barrage of questions and phone calls when clients see their monthly statements. So here's Schlumberger. We actually singled it out right ahead of earnings as a bearish candidate because we felt that there was a strong possibility of negative earnings surprise. And sure enough, we had a sell signal. This is what we call our relative strength sell signal. It came at 78. Bearish earnings surprise. The stock dropped immediately to 68 and then kept ratcheting down all the way to 64. And then they had another earnings report 3 months later, and subsequent to that, stock made a new low. Now, by the way, all 6 pairs of our buy and sell signals are explained on our website. Whether you're a visitor or a subscriber, we go through the rationale behind these signals. Very important to know that they're disciplined, they're filtered by either relative strength or the power gauge. So get these stocks out of your client portfolios. The trend is weak, the industry group is weak, the power gauge is weak. It's no place for your client's money. And Helmerich & Payne was another example, also in the oil machinery services and drilling group. Sell signal ahead of the April earnings report. Stock disappointed as it had the previous quarter. Remember, I told you earnings surprises tend to come in bunches. Patterns repeat on Wall Street. This stock dropped from 66 all the way to 49. And then it went sideways and rallied into the next earnings report. Wall Street is ever hopeful. You got another disappointing earnings report. It shows that they beat estimates, but they guided lower. And this time the stock dropped from 56 all the way to 43. So again, a 25% decline. You can avoid these declines by following this discipline. Now, I mentioned advanced auto parts earlier, giving you an example of a bearish money flow sell alert. On April 9th, in the same way I spotted the apparel stocks as potential buy candidates, I was going through Chaikin Analytics and I saw a preponderance of the big auto parts retailers, Advanced Auto Parts, AutoZone, and O'Reilly, all with bearish ratings, all making new 52-week lows. So in my market letter on April 9th, I said, here are 3 bearish auto parts retailers to sell on strength. Now, why did I say sell on strength? Because they had just made new 52-week lows, and I hate selling a stock that's making a new 52-week low. And sure enough, Advanced Auto Parts rallied, and so did AutoZone to 700. Negative earnings surprise, the stock bottomed out under 500. We've got news in Chaikin Analytics, and I spotted a news story today as I pulled this chart. AutoZone stock rating kept by Bank of America Merrill Lynch with a 625 target, indicating 16% upside potential. AutoZone has remained a buy at Merrill Lynch and other brokerage firms all through this decline from 800 down to 500. You owe your clients more than that. Here's what O'Reilly did. It rallied up after we said to sell it on strength, gave a sell signal ahead of earnings. The stock dropped from 260 to about 235. It then rallied again to 250, giving you a second chance to sell it. 230, then up to 242. And ultimately, when they said that same-store sales were going to be down 4% in July, and we all know it's pretty hard to meet a 14% earnings estimate increase if your same-store sales are down 4%, the stock dropped all the way from 215 down to 170. You can avoid these disasters by following the discipline. And Advanced Auto Parts, which initially bottomed out at 100, had another negative earnings surprise and traded down into the low 80s. That money flow sell alert came at 170. The bearish personality change came at 150. The ultimate low is still unknown, but as of now, it's around 82. I don't know anybody who wants to live through declines like that. Now, we have something that's bundled into Chaikin Analytics that we call our portfolio health check. You can look at any list, ETF, client portfolio, and we have something in there called the power grid. I call it your defensive coordinator. This makes looking at a portfolio, no matter how many stocks are in it, very simple, and it's a great prospecting tool. Imagine that you've got a potential client from another advisor, and he comes to you with a portfolio of 30 or 40 stocks. Instead of saying, well, we're going to sell everything and buy our favorite stocks or allocate it to 10 ETFs or mutual funds, you can be that much more professional than the average financial advisor. Stocks on the bottom left, you want to sell. And this goes back, I don't know, 2 or 3 years. Schlumberger was bearish back then. Stocks on the upper right are bullish rated power gauge stocks in industry groups with bullish ratings. So those are where you want to focus a client portfolio. Very powerful tool, starting to be utilized more and more by our advisor clients. So now you know these 6 key points that we wanted to cover to show you how to protect and profit in a correction. And all of these are possible by using Chaikin Analytics, which is a proven stock selection system. It incorporates our multi-factor model that combines technicals and fundamentals. It also includes a stock discovery engine for finding new stock ideas that we didn't get into on this webinar that's extraordinarily powerful. It operates the way Spotify and Netflix find you music and movies. And it's proven invaluable at finding stocks like O'Reilly and AutoZone and financial stocks when they were really keying up. And then we also have the screener that we showed you, the options play ideas generation, very probability based. And this normally sells Chaikin Analytics for $1,950 for an annual subscription. You can go to chaikinanalytics.com/correction and subscribe right now. Now, as a special bonus for the advisors on the webinar today, we're offering our lowest price ever to advisors for Chaikin Analytics. If you subscribe within the next 3 days, we're taking $350 off the cost of an annual subscription to Chaikin Analytics, $1,600. Plus, if you subscribe today, by midnight, you'll get a 1-hour one-on-one training session. A couple of the people on our customer success team have been financial advisors. They love education. They know your business, your pain, and your methodology. So chaikinanalytics.com/correction. And in addition to everything we've seen, intraday charts, earnings alerts in detail, and my weekly market insights. Plus, as a Chaikin subscriber, you'll get small group tutorials to help you learn what's in the system, unlimited training and support, and if you need it, one-on-one coaching, plus my colleague John Schlitz's daily morning insights that come to you before the opening. So it's a complete package, and it got John Walden very excited, and I know many of you know John and his thoughts from the front line. He said, my analysts are enthusiastic users of Chaikin Analytics and use it to analyze the trades and recommendations of our writing team. Mark's system has been integrated into our routine due diligence process for vetting and evaluating potential investments. High praise indeed from one of the most respected macro analysts on Wall Street. So again, subscribe by Saturday night. We'll take $350 off the cost of Chaikin Analytics. And if you subscribe by midnight tonight, a 1-hour one-on-one training session with one of our customer success team. ChaikinAnalytics.com/correction. Joe, put that link into the chat box, please, and I'll turn it over to you to wrap up the webinar. And thank you so much for staying with us till the end, everybody.
All right, thanks so much, Mark. And again, just to echo Mark's comments, thank you all for joining us this afternoon. That offer, again, is for a full year's worth of access to ChaikinAnalytics.com. I just chatted in that link, ChaikinAnalytics.com/correction, and that is for $1,600 even for a full year to Chaikin Analytics. We haven't done an offer on a thick this low all year long. So great opportunity now that we're back from the Labor Day weekend to get up and running. If you access that link, it'll take you right to a fulfillment page, just as you see right now. A few other things involved. Of course, we have our whole recording, our whole library of recordings for our onboard sessions available for you to check out right now. Plus, take advantage of that one-on-one offer as well. There's really no better training than, of course, on a one-on-one conversation. So we'd love to have you join us here. So again, that's a full year's worth of access to Chaikin Analytics. That's $1,600 even for a full year. We want to thank you again for joining us. Keep an eye out for the recording, which will be sent out later on. Until then, have a wonderful afternoon, and we will look forward to seeing you in our program soon. Thanks.